Welcome back to the channel. It's me, Adam, and you're watching Unlimited Options Investing. In this video, we're talking about the 3 stocks to buy for February 2022. But you know me, I can't just pick 3 stocks. So in this video, we're going to have a little bit of a twist because so many different stocks were absolutely crucified in January of 2022. It was one of the worst Januaries on record. The NASDAQ got just slashed because of the impending interest rates that are set to go up in March, and we don't know how much or how frequently. And a matter of fact, I don't even think the Fed knows themselves how this is all going to play out with inflation and the whole 9 yards. So in this video, what I'm going to be doing is the 3 different categories of stocks that we're going to look at, and we'll look at plenty of stocks within those 3 categories. And essentially for these 3 categories, the first one the least risky, the second one kind of a conservative, and the third one being the riskiest. So if this is your first time on the channel, welcome aboard and hit that subscribe button. Here at Unlimited Options Investing, we talk everything from stocks, crypto, options, ETFs. We're investing for the long term. As always, smash that like button and let's get started. So the first category, the least risky, is going to be full of ETFs, but high quality ETFs. The first one being Vanguard's Growth Index Fund ETF. Ticker symbol is VUG. It's $293 a share, and after hours it actually went up as a result of Google reporting really strong earnings, pushing up the index as a whole. And this is one of my favorite growth ETFs for a long-term investor. It has an expense ratio of 0.04%, meaning $4 every $10,000 invested. The index is made up of large cap companies, all growth companies. And taking a look at the holdings, there's 279. Apple's first at 11.7%, Microsoft at 10.67%, Amazon 6%, Alphabet 3.68%, Tesla 3.6%, Facebook, Meta Platforms now 3.36%, Alphabet again, Class C shares 3.3%, Nvidia, Home Depot, Visa, MasterCard, Walt Disney, you get the point. All high quality names that we all know. The second ETF, Vanguard's Mega Cap Index, MGC, currently trading for $160 per share. Similar to VUG, the expense ratio is also cheap at 0.07%, meaning $7 every $10,000 invested. But unlike VUG, it's not just growth companies, it's a blend of both growth and value. And looking at those holdings, you have Apple again at number 1, but only 8% of the fund, Microsoft 7%, Amazon at 4%, Alphabet, Tesla, Facebook, Alphabet, Nvidia, so a lot of the similar companies, but then you have names like Berkshire, United Health Group, JP Morgan Chase, Johnson & Johnson, more value type companies, and therefore makes MGC more stable than VUG in the short term, making it less risky. And the least risky of the 3, we have Vanguard's Dividend Appreciation Index Fund, VIG, trading at $163 a share. Also a cheap index fund at 0.06%, $6 every $10,000 invested. Like MGC, it's a blend of both growth and value companies, and also large cap companies like the other 2 ETFs. And looking at the top names, you have Microsoft at 4.83%, United Health Group at 3.76%, Johnson & Johnson at 3.5%, Home Depot, JP Morgan Chase, Procter & Gamble, Visa. This ETF focuses more on value. However, all these companies are high-quality names that we know are going to appreciate their dividends. Over the long term, they're highly stable businesses. All right, and for the second category, we're going to be looking at specific stocks, potential cornerstone stocks that we're looking at that are well off their 52-week highs. Firstly, Tesla, now trading at $931 a share with a market cap of $935 billion. If we take a look at the past year, it is up 6.7%. And we're off all-time highs that we hit early in November, just over $1,200. From that point, we're down 25%. And why Tesla, other than the fact it is my favorite company for the very long term, as they're innovating, they're highly profitable, high margins. Who could argue that this market cap is probably going to be a future lean when it's all said and done over the upcoming years? Facebook or Meta Platforms reporting their earnings today on Wednesday, jumped after hours on Tuesday after Google reported their earnings, and also being in the advertising space. Meta went up 3% by association. So right now, after hours at $330 a share, with a market cap of $887 billion, let's just say $900 billion, and taking a look at the past year, we peaked back in early September before the correction, where right now we are below by 15%. My quick bullish thesis on Meta Platforms, they're strapped with cash to the sky. They are by far the biggest social media company in the world. They are, in my opinion, highly undervalued for what kind of company and the size of it. I think the stock deserves a much higher price. I just think there's a lot of fears when it comes to regulations, and everyone just hates Mark Zuckerberg. Keeping it really simple, the next stock, Amazon, now with a market cap of $1.53 trillion, also up after hours, now sitting below $3,100. And just looking a few days ago, we were trading just above $2,700. Looking at the past year, we have gone down 10.5% for a mega cap company at $1.53 trillion. And this one reporting on Thursday, it's going to be exciting. Next stock, taking a look at Disney, a market cap of $263 billion, currently trading for about $145 a share. Taking a look at the past year, we are down almost 20%. And from our all-time highs right now, we are down 28%. So it's been pretty tough going for the Walt Disney Company, but they are looked upon as a recovery play. But as America fully opens and finally put the fears of the virus behind us, Disney parks, cruises should excel from here, as they have been non-existent over the past few years. And when I mean non-existent, at least relative to what it was pre-pandemic. Alrighty, and the last cornerstone stock we have is JP Morgan Chase stock, JPM, currently trading at $151 per share, with a market cap of $446 billion. Also paying a dividend yield of 2.65% annually. And over the past year, we are up 13.13%. However, we see that gain from exactly 1 year ago to about February 24th to when we got to $153. And right now, since then, we're actually down 1.38%. Taking a look at the past 5 years, it is up 74%. So why JPM? Firstly, it hasn't done much over the past 1 year. Like every other stock I've mentioned in this video, it's high quality, not speculative. The banks are going to benefit greatly from the rate hikes. It's a good diversification from anything technology. If anything happens to the economy, they're going to be the first ones to get bailed out, so they're not going anywhere. The last category of the stocks to buy for February 2022, we're going to go through a few higher risk stocks that I wouldn't necessarily base my portfolio around. The first one being Airbnb stock, ABNB. It has a market cap of $98 billion, currently trading for $157 per share. This one IPO'd, I believe, in December of 2020. And as we can see, it's been pretty volatile ever since then. So it IPO'd around 140, climbing up to about 212, then crashing down about 35% to about 135 or so, climbing up another 53% to $206 a share back in November. And since then, since we've peaked in a lot of high growth names, we are currently down 24%. What also did not help was when the new variant came out right before Thanksgiving, and everything recovery just plummeted. And then on top of that, anything technology or hypergrowth has also been getting slashed lately, so Airbnb has not been safe. But in my opinion, I love this company. I love their business model. I am a customer. I'm sure a high percentage of people that are listening to this video have also been in Airbnb before. But the one thing they have, the one competitive advantage that I'm always looking for, is they have this word, a moat. They do something better than anyone else can. They have the competitive advantage. They're first to market, innovative, and brand recognition. Everyone trusts them. Is this one going to 100 first, or is it going to 200 first? I have no idea, but I know in the long term, Airbnb will make tons and tons of money. The next stock being Coinbase stock, ticker symbol is COIN, currently trading for just below $200 a share. A market cap of $42.55 billion. This one being a direct public listing back in April of 2021. And this was the first peak of crypto back in 2021. I'll admit I was a buyer on day one. I averaged down, and I've been holding ever since. Going into this name, it's going to be highly volatile, as it is especially dependent on the price of Bitcoin. At least right now in the short term. What I want to see in the long term is that Coinbase is known, obviously for Bitcoin and crypto and all, but more so for the profits that they're generating on the volume of trading of all these cryptos. Now, I don't expect that to be for quite a while, and I mean years, but based on financials, and I will do a separate video on Coinbase, I think this name and the profits they're generating has huge potential to have a market cap way higher than $42 billion, and that the potential reward highly outdoes the risk. All right, and the last name on the list is Shopify stock, and I have gotten hammered with this stock of late. I was buying a lot back around the 1300 level back in December, and ever since then I have gotten slashed 23%. currently at $984 a share with a market cap of $123 billion. This stock not cheap by any measure. And this one over the past month and a half has had separate 10+% down days. It's been pretty rough. But that's the thing with a growth stock like Shopify, is you're going to have really high volatile times where you can have a violent sell-off from your all-time high, down 52% in a matter of 2 months, but you can also go up 55% in a matter of months as well. So again, not cheap by any measure. This one can continue falling another 50%, but for all we know, we can go up another 50% from here. It's anyone's guess. In the short term, no idea. Long term, Shopify is a winner. Alright, and that's the end of my video. Thank you very much for watching as always. I always appreciate every viewer, every like, every comment, every subscriber. Thank you very much, guys. Let me know in the comments below what you think of my 3 stocks to buy, or 3 categories to buy for February of 2022, because so many different stocks are just below their 52-week highs by significant amounts, probably much closer to their 52-week lows, depending on which stocks you're looking at, because there are so many opportunities in the market, especially after the past month. Let me know in the comments below. As always, like and subscribe, and I'll see you in the next video.